Hi, I'm Seth Freuberg. I'm the Director of Options Training here at SMBU, and I run the Options Trading Desk. Thanks for watching our video blog for this week. I want to discuss something today which is probably on a lot of options traders' minds, which is it bad, always bad, to be down on a trade? Is it always bad to be down money on a trade? Now, some of you are thinking, are you nuts? And you know, in most forms of trading, that would be a pretty accurate assessment of the situation. You get into a trade, you're down money, how can that be a good thing? Well, in options trading, there are times when it's actually a good thing. And I know that sounds strange and counterintuitive, but I want to show you an example so you understand what I mean. Most options income trades, you put the trade on and you sort of hope the market won't move too much. If it doesn't move too much, then time decay will cause the trade to improve profitability-wise, and you can hit a target, get out. Sometimes you get out very early if the market really sits still for a while. On the other hand, there are certain trades which actually thrive. They do better when the market starts moving around a lot before you've scaled in all of your capital, and that's the key, before you've scaled in all of your capital. So there are certain trade types, and we're going to show you an example now, where you scale your capital into the trade slowly, and while you're doing that, you actually want the initial trade to be down money, which sounds strange, it sounds counterintuitive, but I think you'll see in a moment why it's true. So let's start with an example, and this is just one of many trades that you scale into. Would be a short-term bearish butterfly. Now, if you had entered this trade about a month before the March expiration, when the Russell 2000 was trading at about 1160, as you can see in the chart here, that would have been a conceivable entry point for a short-term bearish butterfly. And when you do that, you pop a butterfly on behind the market. As you can see, we've done a butterfly here centered at 1140, 20 points behind the market in this particular example. Now, of course, this was done in late February, and the market rallied quite a bit in that late February, early March period of time. And so the butterfly, which looks like this, clearly the P&L of the trade would go up if the market sold off, but the opposite happened. And believe it or not, we wanted that to happen, because we want to scale more capital into the trade. And the way the trade's designed, you scale more capital into the trade when the market rallies. So there was a big rally on March 4th, but even on March 3rd, we were already down over $4,000 on this hypothetical trade. And you'd say, well, that's a bad thing. But in fact, it's not a bad thing, and you'll see why in a moment. The next day, we really get down a lot of money on the trade. The market has a very large push-up, and this was on March 4, 2014. And if you now look at the trade, you'll see that we actually added two more butterflies behind the market, one at 1160, one at 1180. Well, the Russell ran up to 1206 that day. The market was up early in the morning, over 20 points. And we were not forced to, but the trade plan calls for you to add two more butterflies behind the market, which actually makes the market rally even further, somewhat dangerous for the trade. But we've got now all of our capital in the trade. This trade, at its maximum capital point, will have three butterflies in it. So we're now in all three butterflies. We're down a decent amount of money on the trade, but we got all of our capital in behind the market, which is what we wanted. And if the market decides to take some profits, sell off a little bit for whatever reason, we're going to be in really good shape on this trade, even though at this moment in time, we're down decent money on the trade. And sure enough, a week later, just a week later, this trade, which had been down, more than $10,000 at one point, is now up $10,000 in 1 week, and the market didn't back off substantially. It only backed off maybe 20, 25 points from its highest level, But that was enough because we scaled all of our capital in behind the market, and then the market sold off into the body, what we call the body or the tent of the butterfly. And in this case, it's actually a triple butterfly formation. So as you can see, all we needed was for the market to just cool down a little bit, take some profits, sell off a bit, and the trade, had a lot of potential. But we had to go down decent money to put ourselves into the position of sliding those butterflies in behind the market and then having the market sell off back into the tent or the body of the triple butterfly formation. So as you can see, just a week later, you're up 10 grand. And on the final trading day, and this one went very well, and a lot of traders probably would have taken profits a little bit earlier in this, but just for the fun of it, on the final trading day of that month, for the options expiration, that is, the trade was up $30,000. Again, this is a hypothetical trade. Most traders probably would have pulled out a little bit earlier and pocketed maybe a little bit less profit. But the point of the story, and the moral of the story is, it's not always bad to be down money on a trade. In fact, certain options trades, it's actually favorable at certain points to be down money on the initial trade because it's part of a larger game plan. And the larger game plan in the case of a bearish butterfly is that you wait for the market to rally, and then you wait for the market to take some profits and to sell off a little bit, which almost always happens at one point in a market. You're going to get a retracement, and that's when the bearish butterfly really blooms and flourishes. So if somebody says to you, I'm down on my trade, is that a bad thing or a good thing? You know now what to tell them, which is it depends. If it's a trade where you don't intend to add extra capital, when you're down money, it's probably not a good thing. But when you're scaling capital in and you have a trade plan which essentially calls for you to be down money on the trade before you add capital, then it's actually a good thing. And that's the moral of the story. So if you have any questions about this trade or our options training program, please don't hesitate to contact me at sfreudberg@smbcap.com, and I look forward to hearing from you. Thank you for watching this clip of our Options Tribe webinar. The rest of the recording is available on optionstribe.com. I'm Seth Freudberg, and I've been hosting the Options Tribe since May of 2011. We've brought in options experts from all over the world to make excellent presentations to our members. So go right now to optionstribe.com to learn more about options education, or you can send me an email at sfreudberg@smbcap.com.